It's recessionary resistant when you have the right debt on it and you have a time horizon on it that's going to allow you to make that property recession resistant. Because recessions are blips in time. Yep. They are fluctuations and cycles. Really, that's what they are. They're cycles in time. And if you can manage to go through those cycles, then you'll be fine on the other side. But you have to go through those cycles in order for you to be fine on the other side. And that's how you become recession resistant.
Your network is your net worth. Come listen to some of the most successful people I know share invaluable knowledge, stories, and advice in real estate, business, and beyond. This is Weiss Advice. Whether you want to take your business or personal life to the next level, look no further. Welcome back to another episode of Weiss Advice. I'm your host, Yona Weiss, here on another incredible episode with an outstanding individual that I have as a guest. Always blessed to have amazing guests on the show, and this one is no different. John Azar, welcome to the show. How are you doing today?
Thank you, Yona. I am grateful to be here, and I'm excited, man. I'm excited. I've known you for so long. I feel like this should have been like our fifth episode together, but it is what it is. That's just how timing works out.
It's great. Yeah. And you know what? It's something to say. I think we met first at a conference a few years ago, but it was like we already knew each other in a lot of ways. And that's great. I love that feeling where, you've been in contact with people online, on the phone, on the Zooms and everything, and meet in person. And it's just like you feel like you've known each other for a long time already. So definitely have that feeling with you, John. It's a pleasure to be here. You have, just for our listeners who don't know who you are, if that's possible, a little background. I'd love to, I know you've been in the real estate business for quite a long time and have done a lot of different things. But I would love if you can kind of give, if you would, just a recap of, who you are, what you do, and then we'll get into it.
No, I appreciate it. Well, John Azar, my name. I am the founder and managing partner of Peak 15 Capital, based in Charlotte, North Carolina. I have been in the industry, as you said, for a long, long time. I'm multifamily now and have been in multifamily mostly for the past several years. But even before multifamily, I was I started my first commercial real estate company. It was an investment banking real estate company back in 2004, 2005, after I left my career in equity trading with shops like Morgan Stanley and Royal Bank of Canada Capital Markets Group. I started the structured finance shop back in Boston that dealt with large-scale mixed-use development up and down the East Coast. And we essentially acted as investment bankers for these type of large-scale development deals that ranged anything from hotel conversions to straight-up hotel hospitality build and acquisitions to condo conversion development, luxury condo build conversions. Again, our concentration was major metro areas like Boston, New York, Philadelphia, Miami. And that was the first company that I had to close down as a result of 2008 recession, 2008, 2009. By 2009, 10, it was just unsustainable to stay in business. Unfortunately, we had to close shop and kind of retooled again in 2013, 2014 with my brother, Tony, who was at the time had already had a multifamily platform that we just expanded and kind of built upon and continued to transact multifamily assets until about 2020. And we transacted several thousand doors during that time in the Southeast, mostly in the Southeastern corridor. And in 2020, I launched, really end of 2019, I launched Peak 15 Capital. 2020 was our first full year of operation, a hell of a year to be in first full year of operation, right in the middle of the pandemic. But in a way, you got to be thankful for all the experiences, good, bad, ugly, weird, whatever it might be. They all shape you and give you a different perspective on how you can do business and how you can move forward. And Peak 15 Capital had two arms to it from the beginning. It had a placement arm and for institutional equity on other sponsors' deals because of, again, as you astutely said earlier, I love this industry and I've been in the industry for so long. So I know a lot of sponsors and operators and will continue to have the pleasure of knowing a lot more sponsors and operators. Right. But as a result of that, and we also have through our previous platforms, we still are very well connected to institutional capital, anything from private equity shops, hedge funds to large family offices. So we brought these to the table to a lot of our sponsors and acted as, again, part of our business at Peak 15 is to place institutional equity in other people's deals ranging anywhere from 5 million to 50 million in equity. That's the equity slug on the deal. So And the other part of our business is to continue to do syndications, but in a co-GP way. So we would essentially co-GP on deals with other sponsors and operators that they either bring us the deal or we bring the deal to them. And we would either co-sign on the deal, be the KP on the deal, bring money to the deal, whatever it might take for us to be co-GPs on the deal. Our most ideal situation is to obviously bring money and expertise and when I say our, I mean my signature, my personal signature on the deals, and kind of do the deal that way.
Sure.
So, that strategy propelled us forward into 2022. Towards the middle of 2022, I wanted to launch something that would be a lot more efficient way for us to do the co-GP business. Not just efficient for us, efficient for our sponsor, and efficient for our own investors. Because, as you know, in syndication, you have to retool every time you do a syndication and kind of almost like reinvent the wheel when you have to go back out to market to source the money.
Right.
So we wanted to create a vehicle that was a lot more efficient. So at the end of 2022, a month and a half ago, 2 months ago, we launched our first co-GP fund that would essentially take that strategy of co-GPing with other sponsors and operators that we know and like and love doing business with, and really put it in a fund format. So it allows us to be more efficient in dealing with our sponsors, with more velocity, as well as provide our own investors, our high net worth investors that have been investing with us for a while and will continue to invest with us, thank God, an ability to capitalize on not just one deal, but multiple deals in one shot format, where they would invest with us and they would get exposure to several deals under our fund.
So that's a lot going on, right?
Yes. Sorry. You want me to be efficient. Speaking of efficiency, you want me to be efficient with my time, and I want it to be as brief as possible with as much information as possible.
No, that's great. I love it because just having the experience that you do have. I mean, from what you started, having gone through the previous downturns, I know a lot of people who are in this business have no idea what that's like. I mean, having gone through a downturn, and you said, you were transacting in well over $1 billion in capital through that previous company in the development space. Having to close something like that down was probably pretty traumatic, if I could use a word. I don't know. I wasn't there, but I'd love to hear your experience. For a lot of people listening to this who have no idea what that's like to build up a huge, successful real estate business and then have a major market downturn like a lot of people are predicting coming up soon.
Yeah, I mean, it's crushing. Look, anytime you have to kind of face your own misfortune or failure or whatever, you tend to kind of internalize and catastrophize in your own head. And it's crushing because you start out with having a dream and having a vision of what you could accomplish and what you will accomplish. And you start to get excited about it and you see the fruits of your labor through some years. And then for it to just completely go away because of something that is external, that is not completely in your control, but it affected everybody. And again, obviously, people want to say like, oh, the solace is that everybody went through it. Like, well, that's true. Everybody did go through it. But when it happens to you specifically, to you personally, you don't care that everybody else is going through it. Like, I don't care that everybody else went through it. It affected me. It crushed my life. It didn't crush everybody. I mean, yes, it did crush a lot of other people's lives. But you also have to and that's the thing that you have to get out of your own head and look at it in perspective. It's like, listen, I'm not alone. Obviously, and this is not the end of the world. Like, okay, fine. Like, this is great. You have to kind of lick your wounds, have some perspective on it and say, okay, like, what do I need to do now? I need to provide for my family. I need to put food on the table. I need to continue to earn money. You got to do what you got to do. I had to do what I had to do. I had to go, we had to go back and get day jobs, find my footings again and something else. I had to go back to commercial banking and become a commercial banker. I found that, I worked in VC for a while and venture capital for a while. I did some consulting. I mean, you got to do what you got to do to put food on the table. And that's the bottom line. And then at some point when the opportunity presents itself, then you have to be smart enough to hopefully capitalize on that opportunity and move forward. Yeah. It's, as I'm sure you've heard the saying before, luck is the convergence of opportunity and effort. And that's what luck is. Luck is opportunity and effort at the same time. And when these two converge, you have what's called luck. But there's no such thing as pure luck without the effort and opportunity.
100%. And so you transitioned and successfully, as you mentioned, kind of briefly. I love how you kind of just glossed over the fact that you and your brother partnered on several thousand doors, right, of multifamily properties. And I might add, I think, if I'm not mistaken, you guys basically exited most of those, if not all of those, over the past couple of years, right?
We exited a lot of them. Yeah, for sure. We exited a lot of them. A lot of them were my brothers. Some of them were us in collaboration. But yeah, we've exited a good amount. We still have probably, a good amount. We have close to, 2,500 units or so on that side of the portfolio, 2,000 units maybe. And we continue to look at potential exits or we still look at acquisition on that side of the equation, just in a different lens, obviously, at this point. And that's fine too. I mean, for your audience, like, listen, you're going to go through your business is going to go through a retooling process, and you're going to have to learn to shift gears and do it differently. What worked for you last year or 2 years ago or 5 years ago, it may not work for you next year. It may not work for you this year. And that's fine. It's okay. You know, what got you from point A to point B is probably not the same that's going to get you from point B to point C.
100%. So in all of this and having all the experience that you have had, you actually started a coaching program to kind of train and help other people to make their first deals and try to get into the real estate, the multifamily commercial real estate space. Tell us a little bit about like where the brainchild for that came from and what's the goal in doing that?
Yeah, to be honest with you, the coaching came to me purely as a happenstance to some extent. A lot of people just kind of got to know me, reached out to me and said, hey, do you offer some coaching and stuff like that? So I started doing coaching by that. And the program got created as a result of me wanting to work with people and help people that are in the industry that are coming up, either a newer sponsor or aspiring sponsors. And we started doing coaching a good amount, probably in the past, certainly in 2020, 2021, we did some coaching. And then by 2022, to be honest with you, we kind of faced I don't want to say an existential crisis, but we were retooling these other parts of our business that I probably mentioned to you earlier. Sure. We do institutional placement and we do our own QGP funds. I'm a deal guy. I've always been a deal guy at heart. I did not want coaching to be the predominant business for me. And I found at one point or another, it was just the way that we were handling it because I'm very hands-on. Mm-hmm. And the coaching program was very much one-on-one and very dedicated and very bespoke to a lot of our students. And it was taking a lot of our time. And that's the bottom line. It was just taking up a lot of our time that we could put into some of our deals and in growing our other parts of our business. I had to make a decision, like, is it worth to continue to do coaching and expand that? Or is it worth to continue to expand other parts of our business? And at that point in time, I decided that I needed to kind of put a halt on the coaching program and expand the part of the business that needed my attention the most, which is the institutional equity placement and our co-GP business. And at that time, we were kind of retooling to launch our fund, earlier in the year. And I had to put a lot of effort and energy and money and resources into, the formation of the fund and the conceptualization of the strategy and where it's going to go. So we kind of sunsetted the coaching for a while. Towards last year, I didn't really hardly do much coaching. Maybe the first part of the year I did. Mm-hmm. And we kind of sunsetted the coaching program at that point with some of the students that were really ready to kind of either move on or take a different step. And it's not like I cut anybody off, but the students that I was working with at the time were just ready to kind of retool and do something differently. And I wanted them to go out into the world, Sure.
They got to spread their wings and fly on their own.
They got to spread their wings and kind of try to do the real deal. And, you can only get coached so much until you start to do the real deal. So that's what happened. But now we've gotten to the point where we do have some things that are great and emotions. And I don't want to say on autopilot because you're never on autopilot. You always have to kind of, be engaged in your business if you want it to be successful. But I was blessed and fortunate enough to meet some newer people in the business and some new partners. And this year we're relaunching our coaching program again, but in a completely different way. We're going to have different tiers, different ways to access it, a different way to deliver that education in multifamily specifically, in our business specifically, because there's a lot of coaching programs out there that try to do everything for everybody. And that's not what we're trying to do. We are still very niche-y. We are multifamily guys at heart to some extent. And our coaching program is going to be very heavily weighted into multifamily and the process from A to Z, from identification to exit of a multifamily deal and everything in between, which is, as you know, it's a big chunk. Sure. It's a lot that goes in between. And building the right program is very important to me. And so that's what we're tooling right now to launch a new program that's going to have different tiers for different students and different ways to access the program. Because we found also that, delivering education and coaching to somebody in their certain stage of life may not be the same as delivering the same content or a different kind of content to someone else who's in a different stage of life. Sure. I mean, delivering coaching to someone who's never done a multifamily deal before is one thing. Delivering coaching to someone who's maybe done some multifamily, but they want to learn more. That's a whole nother coaching set altogether, whole different set of coaching altogether. So we're parsing out that program and we're relaunching it soon. in the next couple of months where it's going to offer different tiers and different way to get coached, and even higher tiers than what we did before, because now we're putting our money and our mouth where our coaching is. So
Sure.
meaning that we're going to offer a tier that's going to be the highest tier, and we're going to be calling it like an incubation program where we're actually going to be inculcating not only our knowledge, but also our money behind some of the folks that join us.
That's great. I mean, and that's really the best way for someone who's really serious and someone who has a real drive to be able to partner with essentially someone successful like yourself to do their first deal or do, a larger deal where they may have been focusing on smaller multifamily or what have you. I think that's an awesome program to be able to do something like that.
Sure. Yeah. So stay tuned.
Yeah, we will. And we'll definitely check that out. We'll make sure to put in the show notes if we have some access to that information once it gets live. But I'm curious, you've been, like you mentioned, in the past decade or so, at least, focused pretty solely on like large multifamily properties. I believe that's been your sole focus. And we're talking about 100, 200 units plus. Have you done any other type of commercial real estate out of curiosity, or is your focus in that at this point right now with your new fund in anything else, or is it still in that core large?
Yeah, that's a good question. I mean, we've transacted for the placement part of our business. We have transacted some in non-multifamily, because in our placement business, we look at all flavors of the rainbow in commercial real estate. So in our institutional placement business, we've looked at deals that are industrial, that are hotel conversion deals, that are data centers. And in fact, we're placing for, a data center deal right now where, we look at senior living, we would look at student housing. So no, it's not just multifamily. It's obviously different skill sets and different ways of underwriting and different ways to present the financials. But yeah, for our own deals, we are still very much multifamily guys. But the only transactions we've done outside of multifamily have been on the placement side of the business, right, to answer your question.
Okay. And so going forward, I mean, right now you've just created this, large fund where you're, going to be deploying capital into multifamily projects. I mean, do you see right now, I know I've talked to a lot of people recently about kind of what's going on in the marketplace. And I mean, how do you see it as someone who's gone through a lot of gone through a lot of downturns? Do you expect a similar thing right now, or are you just, building that fund to be able to place capital once deals come about? I mean, I'm just curious of what your game strategy. I don't know if I formulated that question as well as I had it in my head, but what's your strategy right now in this 2023?
No, I get it. The game strategy is very opportunistic. The game strategy, to be blunt about it, is take opportunity of the blood that's going to be on the street. And there's going to be blood on the street, no doubt about it. And that's not something that scares us. That's something that, to be honest with you, that encourages us. And the blood on the street is not going to come from deals that were well thought out, well underwritten, conservatively bought with responsible debt, responsible way of approaching it. Those deals are going to be fine. Those deals are going to weather the storm, and they're going to come out not only smelling like a peach, they're going to come out in a great shape. It's the deals that were irresponsibly bought, irresponsibly underwritten, not enough data, too ambitiously, over ambitiously bid on or bid up, bad type of debt on it, or just risky, irresponsible way to put debt on it. Those are the deals that are going to create the blood on the street. And there's been, I hate to say it, there's a lot of those deals out there. There was a lot of those deals. Some of them were done by, sponsors and operators that didn't know what they were doing. Some of them were done by sponsors and operators that did know what they're doing, but they just got swept up in the euphoria of the market and of the greed of the market that was going on. You have that euphoric high that, man, things are going to be good forever. Things are not going to be good forever. Clearly things are not going to be good forever. And if you operate based on those assumptions and hope, I don't like the word hope, by the way. That's one of my pet peeves, is hope that things are going to continue to be as grandiose and as productive as you've anticipated them. Those are the people that are going to get crushed, and they're going to get crushed big time. And we've already started to see the trickle of that. Already, some of those deals have already started trickling in. You don't have to wait, and people ask me that all the time. Like, well, do you have to wait until a certain time of the year? Like, when do you think that's going to start? When do you think that tsunami of good deals are going to start? When do you think, should we wait until summertime? There's no such thing as waiting. You are in the market. There's no such thing as timing the market. You just got to be in the market. I've always said that. My people always have heard me say that, and they probably are sick of me hearing me say that. There's no timing the market. There's time in the market, not timing the market. Because when you're in the market, you're going to be able to find the opportunities. When you're out of the market and you take yourself out and say, I'm going to time it, I'm not going to do anything, I've made a strategic decision to be out for the next 6 months. Okay, so what if a deal comes along in 2 months that was amazing, just amazing? You're going to miss it. You're not going to even be able to identify it because you're technically out of the market.
Sure.
So, you got to be in the market to identify deals. I mean, a prime example is a deal we're under contract now in the Atlanta area that was just amazing. And it just happened to be that we caught it at a fantastic price. The seller needs to offload it. And we just, the debt was right. The scenario was right. The selling scenario was right. Our partner co-sponsor was right. All the stars align, and you just got to continue to find these type of deals. And I think we will continue to find these deals. To answer your earlier question, sorry, Yona, I'm parsing my answer slightly. We are in a different spot than we were in 2008. If that's what part of your question was asking is, how does this compare to what we went through in 2008?
Right.
In 2008, there's not a whole lot of money on the side. Liquidity was very tight in 2008. Liquidity was very tight. Leverage was extremely high.
Right.
These two things are not existent right now, or they do, but they don't exist in the same way as they did not as prevalent as they were in 2008. In 2008, everybody was over leveraged. Homeowners were over leveraged. Consumers with credit cards were over leveraged. Businesses were over leveraged, and money was nowhere to be seen on the sidelines. There was not a lot of liquidity on the sidelines because liquidity was over leveraged too. Unfortunately, today, that is not the case. There's plenty of liquidity on the side. There's plenty of money looking for a good home, but in a good way. So they're a little hesitant. Yes. And they should be hesitant because they should find the right opportunity, not just gush into opportunities just because they presented themselves. So liquidity is here. Leverage. Yes, there is leverage, of course, but nowhere near the levels and the irresponsible leverage that we saw back in 2008. And to be honest with you, consumerism is still very much alive and kicking today. So that will probably help buoy some of the sort of the demands and the pressures, downward pressures that we saw back in 2008. So that will offset it a little bit here today. So are we going to see a retrenchment or some kind of a flop? Yeah, I'm sure we will. But I'm going to put it out there. I don't think it's going to be anywhere near the levels and the sort of the deep lacerations that we saw in 2008, 2009.
100%. I love the fact that, having been through that and seeing the difference between now and then really gives a lot of perspective. We hear a lot of people talking about how multifamily property is recession resistant. People like to use that term, right? Yet at the same time, you have people doing deals that just don't necessarily make sense. And we saw it a lot. We have a lot of people, getting high leverage bridge debt, assuming a lot of rent growth, when in fact, in many markets, rent has done the opposite against their underwriting presumptions. So, how do you differentiate between that, the recession resistant that's there, but at the same time, you have people that are actually losing money on deals?
It's called time, Yona. Time is the ultimate differentiator. So, it's recession resistant if you have enough time to play with. It's recession resistant if you put the right debt on it. It's recession resistant if you have a 10-year outlook or 7-year outlook or 6-year outlook as opposed to 16 months outlook. And that's what people were buying based on some kind of a 12 to 16 months outlook. It ain't going to be recessionary resistant in 12 to 16 months. Right. You don't know what the hell's going to happen in 16 months, 12 months. If you're buying based on a 12 to 18 months turnaround, it's not recessionary resistance. It's recessionary resistant when you have the right debt on it and you have a time horizon on it that's going to allow you to make that property recession resistant. Because what are recessions? Recessions are blips in time. Yep. They are fluctuations and cycles. Really, that's what they are. They're cycles in time. And if you can manage to go through those cycles, then you'll be fine on the other side. But you have to go through those cycles in order for you to be fine on the other side. And that's how you become recession resistant. You don't become recession resistant by saying, I'm going to buy something today and turn around and sell it in 12 months from now and make a boatload of money.
All right. Yeah, that makes sense. And I think that's exactly where we're going to see people, like you said, getting in trouble. So we're, hopefully going to see some good things for good people in the next few months. And we're hopefully going to hear good news, right? But unfortunately, I know a lot of people who unfortunately did some deals that I would never have invested in, and they were overly opportunistic and unfortunately, maybe young, maybe inexperienced, but I think a lot of people are going to be getting in trouble. And those people who do have the experience and do have the 10-year outlook are going to be very successful in the next 2 years, I think.
100%. Debt is such an important part of the equation in this business, and putting the right amount of debt and giving you the right kind of horizon You got to plan for that. And I'm a fan of all kinds of different kinds of debt. I'm not saying bridge is bad because I like bridge. I'm not saying that mezz is bad because I like mezz. I'm not saying that long-term debt is bad because I like long-term debt. I like all kinds of debt. You just have to apply it in the right situation, in the right format, and in the right deal. Putting the wrong kind of debt in the wrong deal or in the wrong time horizon is going to leave you with some undue exposure, and your beta is going to skyrocket. Your beta is a measure of risk, and so your risk is going to skyrocket.
Love that outlook. That's so true. It's like so many things, right? Fire is not bad. Fire is, good or bad, depending on how you use it. And I think that
That's right.
There's so many principles to learn out from that in everyday life.
Right. That's right. And time could be your friend in so many different ways and could be your enemy in some different ways as well. In order for a lot of people to take advantage of what you so aptly do, there's got to be a certain time horizon to play with.
Correct.
They can't institute cost segregation and depreciation of asset if you're just going to hold on to something for 12 months. That doesn't make sense.
Correct.
It just makes no sense. If your outlook is to sell something in 12 to 18 months, you're going to shoot yourself in the foot, because you're not only going to shorten your time horizon and you're going to truncate the amount of time that you have to you got to be really precise to make money at that exact time. Where if you just if you just long your time horizon by just a year or two, make it 3 to 5 years, 5 to 6 years, something like that, you'll be able to not only have some breathing room and some oxygen into your deal, but also going to be able to institute things like what you do, which is the cost segregation, and take full advantage of tax appreciation that doesn't even happen in short time deals.
100%. Awesome. John, I want to transition now to what we call the final four. These are 4 questions I ask all my guests. First question to you is, what is the worst job that you ever had?
The worst job I've ever had. Yeah, the worst job I've ever had was probably a job that also taught me a lot. So I don't know if there is, because we learn from everything, good and bad jobs, I think the worst job I ever had was probably selling copiers door to door. That, to me, at one point when I was young, and this was after college, I sold copiers. I sold copiers door to door to offices. And that was just horrific to me. So that was, but again, I learned so much from knocking on doors that way. I learned so much from just cold calling in that way. And that, that takes cold calling to a whole different level, because you're not only picking up the phone and cold call, you're actually walking in somewhere and literally knocking on doors and saying, "Hey, I got copiers to sell. Would you be open to buying or renting one of our copiers?" And, talk about no's, man. You get the no's take on a whole different perspective. The no's are very visceral in that, they're not just a phone hang up. There's somebody kicking you out of their office. So,
right. Exactly. And sometimes with security, sometimes all kinds of things.
So that was probably the worst job. But again, it taught me so much.
Yeah. It can be demoralizing in many ways, for sure. Second question, what's a book you've read that's given you a paradigm shift?
A book I read that gave me a paradigm shift the book is called Hope is Not a Method. And it really teaches. It goes through the whole, so there's a process in the military it's called the after action review. And it's very well known in the military circles. And it's basically getting together whatever the teams that have done certain operations or certain missions or whatever, they get together afterwards and kind of recap what went right, what went wrong, what they can do better next time. And that's really one of the main premises of the book is talking about that strategy, but also in a large way, talking about putting strategy in place, putting a plan in place. And the premise of the book is that you can't rely on hope. Hope is not a method, as the book said. Hope is not a strategy forward. That's not, it goes back to what we were talking about earlier, people who are buying and hoping that things are going to be fine without an actual discernible strategy of, well, what am I going to do if things go bad? What am I going to do if things shifted? That's probably one of my favorite books, and one that have definitely created a paradigm shift for me, mentally, that I read years and years ago.
Sure. We'll make sure to put that in the show notes. It's the first I've heard of that, but sounds like a really important book to read for anyone. Definitely looking forward to that.
Yeah, no, absolutely. You can put in the show notes it's by Gordon Sullivan. He's a retired U.S. general with the U.S. Army. Awesome.
Well, yeah, we'll make sure to do that. Third question, what's a skill or talent that you would like to learn?
A skill or a talent. I am a huge lover. I'm a huge foodie, and I love to cook all the time. So I would like to upgrade my cooking skills, my cooking chops, and learn to cook in a more professional, different way, and create different sauces, different dishes. So I would love to kind of continue to learn in that arena.
There you go. That's awesome. That sounds like a fun thing to do. I enjoy cooking as well. It can be fun when you create something. Fourth and final question, John, what does success mean to you?
Success means the ability to maneuver in things that you love without having to look behind your shoulder and having to worry about, how am I going to make it financially? Success looks like, being able to enjoy things with your loved ones, without having to worry about if I can afford to let them be with me. Or success is seeing the fruit of your labors in your kids and them following a path that is amazing, happy, successful for them, because success to them may not be my success.
Right.
Success to me is not going to be the same as their success, but the ability for us to be together as a family, that's success. All these aspects to me is what success is. Success is a state of mind that you can get to in life that is more of a blessing than anything else.
Right.
And to be able to do things that makes you excited and happy on a day-to-day basis, and continue to pursue things that make you excited and happy on a day-to-day basis while you have all other things in your life in a balance. That's success. Because you can continue to pursue things, you can do things that will hopefully make you happy or successful, but if you let a lot of other balls drop in your life, you're not going to be successful. That doesn't mean success. Success is not pursuing everything when you're neglecting so many other things in your life.
I love that definition. I appreciate that so much. John, where can our listeners find you or reach out to you if they want to?
They can find me on social media. I'm on LinkedIn under Jalal John Azar. They can find me obviously on our website. It's peak15cap.com, www.peak15cap.com. They can email me, Azar, A-Z-A-R, at peak15cap.com. All these are on Instagram, although I'm not that active necessarily on Instagram, but I try to post. My people try to push me to be outside of my comfort zone and post more often than I like, but I try.
That's great.
Yeah.
Awesome. Well, I appreciate you taking the time out of your busy day. I'm glad we finally got the opportunity to do this. I think we timed this pretty well, I would say, in terms of, the value. You can bring value all the time, but I think this episode was just phenomenal. So I appreciate you taking the time, John. Thanks so much.
Absolutely. I'm so thankful for you and your existence in my life.
Well, I appreciate that. And thanks to our listeners again. I appreciate you guys for tuning in once again, all the way to the end. And remember, the best advice comes only when you ask. Real quick, I have one question for you. Did you like this episode? If you did, I want to ask you a huge favor. See, the biggest thing that helps this podcast grow and that will spread this message to the whole world is that if you leave a review, a rating, and subscribe to the podcast. What that does is it basically tells the platforms that this podcast is out on is that you like my stuff and I'm doing something right. So take a few seconds out of your day, hit that subscribe button, leave a rating or review. I would be extremely grateful. Also, I want to hear from you guys. So I want to hear some feedback. If you have any questions for future episodes, please find me on LinkedIn, send me a DM, connection request, Yona Weiss, and I'd love to hear from you.